In this video, you're going to learn what a capital stack is and how you can use it to put together a commercial real estate deal. Okay, so in this video, I'm going to share with you what a capital stack is, why it's so important, and how it's structured in a deal. All right, so basically a capital stack is a combination of your equity, the amount of money you put in, and the debt or your loans you're going to get. So it's a combination thereof. Okay. Now, what it is, it's a stack, okay, capital stack, or layers of money to finance your commercial deal. Let me give you a quick visual example. Okay, I have 3 books here. Okay, Good to Great, which is a great book. This other book is called Deep Work and How to Focus, and this last book is called How to Father. All 3 books are really important to me. So I'm use this as an example. Let's say you have $1 million deal, okay, and you're going to have to put down as a down payment $250,000, right? So you're going to borrow $750,000. Let's say that this book here is the loan for $750,000, okay, and on it I'm going to stack the down payment, okay. So it's a capital stack. Right. Now, let's say I don't have all the money. I don't have the $250,000 in total. Let's say I have half of it. So I have $125,000, right? So I'm going to get an investor. Investor is going to put up $125,000, okay? And then I'm going to put up the remaining $125,000 to complete the stack. So I have $125,000, another $125,000 from my investor. There's my down payment plus the loan of $750,000. Completing the $1 million commercial financing. Okay, so this is a stack of equity and debt, capital stack. Got it? All right. So now, next what I'm going to do is share with you why is it so important to understand this principle of capital stacking. It's because it's one of the most important concepts in evaluating risk and return on investment in a commercial deal. And I'm going to give you an example to show that to you in a second. Okay? And how is it structured? Okay, here's the big picture. The higher you are in the capital stack, the highest ROI you get, but it's also the highest risk. Okay? And then vice versa, the lowest you are in the capital stack, okay, the lowest ROI you get, but you also get the lowest risk. All right, so now, hope you have that quick visual in there. So now what I'm going to do next is give you 3 great examples of how it all works. Let's do that next. All right, here we are with a real-world example of what an actual commercial capital stack looks like. Okay. All right. So I'm going to use one deal, but I'm going to do 3 scenarios. Okay. And here's the deal. It's a $1 million commercial deal, right? And we have a down payment of $250,000. That means we're going to get a loan for $750,000. Okay, so that's the premise of the deal. All right. So here's capital stack number 1. Capital stack number 1 is, again, it's a $1 million deal. I'm going to come to the table with equity or a down payment of $250,000. Okay, and then I'm going to get debt, put debt on the property or a loan of $750,000. So this is 2 layers, or a stack of 2, a stack of an equity portion and a stack of a debt portion to equal the $1 million transaction. Okay, so this is pretty typical. Okay, now I'm going to go up a step in complexity to scenario number 2, where I still have debt and equity, right? I still have a $1 million deal, but I'm going to break up the capital stack differently. Watch it here. So this equity portion, the down payment, you're going to put down $50,000, but you're going to bring another equity portion with an investor. Investor's going to put up $200,000, so you have your down payment of $250,000 now, right? And then you're going to get a loan for $750,000. That equals $1 million. Okay, so this capital stack has 3 layers. Okay, now here's an additional one here. This is scenario number 3, where we do something a little different, but it still comprises of equity and debt. Okay, so we have an equity portion, your down payment of $50,000. Okay, and we're going to bring in an investor for $150,000. So I have 2 pieces of equity. Okay, that are going to equal $200,000. But remember, my down payment is $250,000, so I'm short. So what I'm going to do, I'm going to go back to the seller and have the seller carry second mortgage for me of $50,000, satisfying my down payment of $250,000. Okay, and we call that debt. So it's in second position. So seller carry second mortgage. Okay, now and then I have my loan from a bank of $750,000, thereby equal to $1 million. Okay, so this portion, this capital stack has 4 pieces. This has 2, this has 3, this has 4 parts to the debt and equity portion of the capital stack. Okay, now as I mentioned before, we do have there is a risk and reward to doing all this. This is why it's really important to understand this. So the higher you are in the equity, in the stack portion, the higher the return and the higher the risk, and the lower you are, the lower the return and the lower the risk. Here's an example. Let's say that this is your deal here, and let's say it, you make a whole bunch of money. It's very successful. You make a whole bunch of money. So you put in $250,000, you sell the property, you make a bunch of money, right? This person here in the debt portion, this lender, they get their $750,000 only. They don't get any other profits. Okay? And vice versa, if you were to fail on this project, you lose the $250,000, but the bank still gets their $750,000. Okay? All right. So that's how that works. All right. This should be $750K, by the way. Okay. All right. And the same thing here. So high risk, high reward, low risk, reward. Same thing over here with the equity portion. If you're very successful, right? You make a bunch of money. Your investor make a bunch of money, and then on the debt portion, they just get their $50,000 and their loan. All right, and vice versa. If it fails, you and the investor lose your money, but the second mortgage and the first mortgage gets paid off. Okay, all right. So make sure you understand that part. There's a risk and reward to understanding how the capital stack is structured. Now, all right. So next, what I want to do is get a little more technical with you and share with you, break down in the Wall Street world, in the syndication world, what an actual capital stack looks like. I'm going to define some terms with you, and I'm going to give you 3 really, really important tips for you to move forward with your own capital stack. All right, let's do that next. All right, I am going to get a little technical with you, so bear with me. When you Google capital stack commercial real estate, what's behind me is going to come up. It can be very confusing. So in a couple minutes here, I'm going to break down everything for you to simplify it for you using my previous deal. Okay? All right. So again, when you Google capital stack commercial real estate, these 4 terms are going to come up. Okay? So according to Google and other sources, a capital stack is defined as these 4 things: common equity, preferred equity, mezzanine debt, and senior debt. What in the world does that mean? Okay, so I'm going to share with you what that means. All right, so the common equity, okay, top part of the pyramid, okay, where it's the highest risk and highest return is your money. Okay, that's your down payment. Okay, the preferred equity, which is right here, preferred equity is the investor money. Got it? Okay. Mezzanine debt, okay, mezzanine debt. Many of you, you look at the word mezzanine, and when you're in a building, we have a building with a mezzanine deck. It has a nice little area for people to sit down and do business meetings. So it's called, go to the mezzanine and meet us there. So it's the debt that's higher than the bank loan debt. So it's a mezzanine debt, okay, that's the seller carry second mortgage. So it's a loan, okay? And then the senior debt is the debt you get from the bank. Okay, so again, when you Google capital stack, these 4 terms will come up, and they don't explain what it is in layman's terms. Here's what it is. Okay, now got it? All right. So now what I want to do is give you 3 conclusions to what I just shared with you about putting together a capital stack for a commercial deal. Number 1 is position matters, right? Where you are in this capital stack matters to your profits, your cash flow, your risk, your ROI, everything matters where you are positioned on this capital stack. Number two, the capital stack identifies who has the rights to cash flow and profits and in what order. Got it? And then number three, the capital stack, it identifies or lays out the rights to if there is a default or failure in the deal. Okay? All right. So there you are, capital stack. So I know it's a complex term, but hopefully I have debugged it for you. So now you understand, and it's going to put you in a better decision to do better deals and to have less risk in your deals. All right. Thanks everyone for hanging out with me today. If you want to learn more about what we do, go ahead and apply to be our protege. The link will appear right on the screen. But if you just want to read more on commercial real estate, I have a book I'll give to you. It's for free, no obligations. It's called Commercial Real Estate for Beginners. The link will appear right on the screen. But hey, if you just enjoy these videos, go ahead and like the video. Go ahead and subscribe to our channel, and we'll send you more videos. All right, everyone, thanks today, and I'll see you at the next video.